From New York City for our viewers worldwide, I'm Jonathan Ferro with 30 minutes dedicated to fixed income. This is Bloomberg Real Yield. Coming up, Amazon joins the debt issuance binge. US high-grade companies have sold almost $1 trillion worth of bonds this year alone. White House volatility. One-day havens rally on rumours that Gary Cohn could quit, reversing the next day on a report Bannon could be fired. And counting down to Jackson Hole, Fed Chair Janet Yellen and ECB President Mario Draghi meet in Wyoming. We begin with a big issue, a year of monster debt issuance, and Amazon joins in.
That's really the elephant in the room for us, is what are they going to be tomorrow?
There's a little bit of a leap of faith there.
Yeah, it's a little concerning.
From a credit perspective, you've got kind of an opaque business model here. You don't have a lot of disclosure to the markets, and that makes it tough for us.
This is a dynamic that you see really across the market. Still, even after we are well into a Fed hiking cycle, the borrowing costs for U.S. corporates, not to mention European corporates, are still near the lowest that they've ever been. So this still remains a very good time from a cost perspective for corporates to borrow money.
There's still this ongoing demand for yield. You think about it, the Fed is going through, as we talked about, this process of slow balance sheet adjustment and policy normalization. But it's happened at such a glacial pace, and there's still such an extraordinary demand.
All these companies have taken full advantage of this huge demand, so they're issuing long bonds at very tight spreads, and so the corporate market overall has extended quite a bit.
Central banks around the world have bought 15 to 20 trillion of fixed income assets. So, I mean, that money, private investors have to buy something. They have to buy something and go somewhere.
Joining me around the table today is Subadra Rajappa. She's head of US rate strategy at Societe Generale, and Krishna Memani, CIO and head of fixed income of OppenheimerFunds. Also coming to us from Chicago, Matt Freund, Co-CIO and head of fixed income strategies at Calamos Investments. Krishna, let's begin with you, sir, and let's just talk about the 40-year security that Amazon came to market with, and the amount of duration that's come into the index this year. The amount of duration is increasing, yet the index is increasingly tight. Help me work through that.
Well, so I think what that is telling you is that the companies are making the right decision. That is, debt is very, very cheap, and therefore extending your duration as much as possible, as much as you can, is something that you should do. The real question is, why are investors buying it? And I think the reason investors are buying it is because they have no other choice. So for any portfolio that needs long bonds, the government bond market doesn't give you enough yield, and therefore you go in the corporate bond market to get that yield. It's really that simple. We can make it complicated, but it really isn't.
You just wonder what kind of deal you're getting, though, if you're forced to buy something like a 40-year technology company.
So I think that's a very good question. I think when you're buying long duration paper, ensuring that those companies would be around or have been around for 30, 40 years is something that you should pay attention to. Having said that, I think a lot of these companies, we could have said the same thing about IBM 40 years ago, and they're around, and Microsoft and all of those companies. So I think it's really more about credit analysis about the company rather than making a generic statement.
Well, Matt Freund, let's try and do some credit analysis. It's a 40-year security, 1.45% over treasuries. What were your thoughts on it?
So when you think about Amazon, Tesla, or any of the disruptors that are out there in the market, we find those challenging from a fixed income perspective. They have tremendous promise in terms of future profits, but they don't have a lot of profits today. So if you think about Tesla, it's a very large holding in our convertible portfolios. We like the upside-downside ratios there, but we passed on the most recent deal because we didn't think we were being paid enough for the risk. So I totally agree with your other guest. It really is a credit by credit decision. And for some of the disruptors, you're better off on the equity side or the convert side than you are on the fixed income
let's talk about that, Matt. You've hit right on it. It's an equity-like dream. It's captured by the equity. It's not going to be captured by the debt. The most you can hope from the debt side of the story is just to get repaid. And if you look at the performance of Tesla since that issue came out, actually that issue has been absolutely hammered. So it makes me wonder why people were buying into it in the first place at the kind of levels they did, Matt, when so many people warned about it.
Yeah, again, there's a lot of things to like in the Tesla story, and I'm certainly not going to talk about the motivations of the other buyers. But at Calamos, we take a very bond-by-bond, very heavy credit-focused approach, and you really have to look at the risks versus the rewards. And again, for a lot of these new issuances, they're just not in balance.
Subadra, many people have come out and they've talked about cautioning what's happening in the credit market, maybe some complacency. The Federal Reserve often likes to come out and talk about valuations, but they usually talk about stocks. Should they be looking a little bit more about what's happening in the credit market?
I think they look across the spectrum on a variety of products. They look at commercial real estate, they look at auto loans, they look at what's happening in credit markets. And a lot of the Fed speakers have alluded to the fact that financial conditions are extraordinarily easy right now with the rally in equities and the tightening of credit spreads. So that's something that's definitely on the top of their mind when it comes to tracking financial stability. And this is something that we'll be looking for in Yellen's speech later this week when she speaks at Jackson Hole, because that's going to be the centerpiece of her conversation. We're
going to get stuck into that in just a moment. For the wider issuance story, we spoke to Gershon Distenfeld of AB a little bit earlier. He was keen to point out that, yes, the numbers are huge and they're making a lot of headlines, but ultimately what matters, Krishna, is net issuance, not gross issuance. Absolutely. It's what the money's being used for. Absolutely. And when you look at the picture that way, $1 trillion is the big gross issuance number. When you look at net issuance, are things a little bit more favourable towards credit?
Absolutely. So I think the key point is if you're a central bank, kind of looking at valuations in and of themselves is meaningless. So spreads are at 100. What does that mean? What you really care about is what is the rate of credit growth in the economy. And if that credit growth is extraordinarily high, that's something that should bother you. Having said that, and if you look at what the rate of net credit growth, that is, if you look at what the net credit growth rate has been in the economy since the financial crisis, it is higher than what it used to be before, but relative to the pace of credit growth historically, it's still significantly lower. Clearly, the highest pace of credit growth rate is really in the corporate sector. So from a vulnerability standpoint, that's where we should focus on, but we are nowhere close to the rates that we saw in 07, 08, 06, those periods.
Matt, I do want to talk about what's met supply, and it's been a huge hunger. The demand side of the pitch has been massive. The order books for some of these issues, huge. How important is the indexing role in all of this, given that as a company, if you come to the market and issue even more, you'll make up a bigger slice of the index, and as an investor, if you get a slice of that issue, there's always going to be someone there who wants to buy it.
Well, I think you hit on a really important point. So indexes, especially cap-weighted indexes, are momentum strategies. And on the equity side, you can argue that that's okay. You're allocating more to more successful companies. On the fixed income side, you're allocating more to the more reckless borrowers. And I'm not sure that that's necessarily a great strategy. And I think a lot of research has shown that on active fixed income portfolios, managers have a much higher hit rate or success rate of beating those passive indexes. So it's a really important point. The strategies that may work on the equity side, I think, are dangerous on the fixed income side.
Guys, you're all going to stick with us. Subadra Rajappa from Societe Generale, Krishna Memani from OppenheimerFunds, and Matt Freund from Calamos Investments. Coming up on the programme, the auction block. Amazon, not the only tech giant to sell bonds this week. Apple heads north for its offering. We'll get into that in just a moment. From New York, for our viewers worldwide, this is Bloomberg Real Yield. I'm Jonathan Ferro. This is Bloomberg Real Yield. I want to head to the auction block now. Usually August is a slow month. Not so much this year in 2017. The Amazon deal, along with British American Tobacco, are driving the second biggest August for corporate bond issuance in a decade. The high-volume summer has pushed US high-grade sales to almost $1 trillion this year. And over in Asia, so far this month, it's at a record. It's no different. $9.3 billion have been sold, more than double when compared to the same period a year ago. And an example of this busy summer, Apple sold $1.96 billion of 7-year bonds in Canada to fund, guess what? Yes, you guessed it, buybacks and dividends. It's the biggest single debt offering by a foreign issuer in Canadian dollars. In the world of treasuries, well, the treasury market this week was whipsawed by rumours that Gary Cohn could quit the White House. According to an official, the top White House economic advisor who has been leading the Trump administration's effort to overhaul the US tax code will remain in his position as the director of the National Economic Council. But just why is the former Goldman Sachs president seen as such a critical figure on Wall Street? Still with us, Subadra Rajappa from Societe Generale, Krishna Memani from OppenheimerFunds and Matt Freund from Calamos Investments. Krishna, why is that? Why is he seen as this face of tax cuts and all that is good for Wall Street?
So, there's a significant amount of expectation built into the equity markets with respect to tax policy.
Yeah.
And the center of tax policy initiative, which is typically the Treasury, in a typical administration, that's not the case ever since Mnuchin became the Treasury Secretary. The center of that nexus is really Gary Cohn and the White House. That's where the policy initiative is coming from that'll go to Congress. And I think that's why it's important, and it's real.
Do you think the rates market, Subadra, should be moving that much on the potential direction? At this point, the White House has denied it, but the potential direction of one single policymaker in the administration?
The move in the last week hasn't been because of just,
Of course not.
The Gary Cohn story. There's been a lot going on the geopolitical side as well as on the political side in the U.S. But yes, I think that the market is, like Krishna pointed out, is waiting for meaningful tax reform, and he's seen as the leader of this whole initiative in the White House, as well as working with the Treasury Secretary. So that's why I think he's so important.
Matt, we have this push and pull. On the one hand, it's kind of risk on if Gary stays, and it's risk on if Bannon goes. What do you make of that interpretation by investors at the moment?
Yeah, I think any given day, any given headline, you can point to that direction. I think when you think about valuations are kind of high in the equity markets now, and they're bouncing around. I think when you look at Treasury rates, we think Treasury rates are about right, but again, there's some normal volatility, especially for August. And in terms of what's priced into the markets, we're not pricing in significant tax reform this year. I think you're seeing a lot of uncertainty being generated, and I think that uncertainty, it's easy to have an opinion, but you can't have a lot of conviction behind it.
Well, Subadra, the other push and pull, the tug of war added into the White House volatility is just financial conditions. We touched on this, and the Federal Reserve, they've been hiking, but financial conditions have got easier and easier and easier and easier. Is that a problem for them, or is that just a green light to say, hey, keep going?
It's actually a good thing for the Fed. What it is it's a problem for the ECB because, if you look at things in Europe, the euro continues to strengthen. Inflation is still a problem for Europe, but for the U.S., I think it's a perfect situation, especially as they're getting ready to unwind the balance sheet, and there's indications that they're going to continue to hike, possibly deliver another hike in December.
It's an intriguing one, though, Krishna, because yes, financial conditions are easy and that's a green light to hike, but the data, the economic data, is not a green light to hike. The inflation data is softer, so the real tug of war is the soft inflation data versus the very easy financial conditions that they're actually concerned about the financial stability aspect of.
Yes, so I think they have taken on this third mandate of financial stability. I think what they ought to focus on is making sure that the growth doesn't get hampered in any significant way because of their policy moves. So instead of enjoying the circumstance, which is they're building themselves room by tightening policy while financial conditions are not tightening in and of themselves, they're bemoaning the fact that financial conditions are remaining easy. That's a good thing. That supports the economy. I don't know why that is such a terrible thing to be happening.
William Dudley earlier this week talked about a market that actually had priced in to some extent some stimulus. Mm-hmm. He also talked about his own forecast and said that his forecasts haven't changed. Now, I find that intriguing because if you match up the Fed's forecast to where inflation has actually ended up, does he have to change his forecast? Does the Fed need to revisit their forecast again?
Well, nobody believes anything that the Fed puts up with respect to inflation expectations and path of rate policy anyway. So yes, he can change that and bring it back to the market and say that, well, declare victory. But I think doesn't really make any sense because the key issue here is the Fed and most people at the Fed are still sticking to the Phillips curve in some fashion or the other. And what we are finding out in the real economy is that, well, it's at some point it worked. Today it's not working. So what are you going to do? And what they're telling us is they'll continue to tighten, and the market continues to discount that assertion.
Matt Freund, did you want to jump in, sir?
I did. So a couple really, really important points. First, history is important only if you look, and it is very unusual for the Fed to be raising interest rates and financial conditions to be accelerating like they are. We think that's because of the actions of global central banks. So the Fed is starting, first they took their foot off the accelerator. Soon they're going to be tapping on the brakes, and it really depends on how hard the rest of the world's central bankers push from behind to keep those conditions easing. So that's getting much harder to analyze. To the point of hiking rates, typically they hike rates when inflation is a problem, when inflation is accelerating, and now you see it rolling over. And I really think it's because their models don't work in an environment of high debt. We've come through a balance sheet recession, not an inventory-led recession, and whether it's debt or demographics or the combinations of the two, their models are not working in the current environment.
Guys, you're going to stick with us. Subadra Rajappa from Societe Generale, Krishna Memani from OppenheimerFunds, and Matt Freund from Calamos Investments. Let's get you an update on the market this week, shall we? Bonds, what a whippy week it's been for Treasuries. Yields do close out the week, though, very close to the close. Up 2 basis points on a 2-year, up a single basis point on a US 10-year at around 220 on a 10-year. From New York, still ahead, the final spread. The week ahead features Janet Yellen and Mario Draghi at the annual Fed conference in Jackson Hole, Wyoming. This is Bloomberg, Real Yield. I'm Jonathan Ferro. This is Bloomberg Real Yield. Time now for the final spread. Coming up over the next week, military drills involving literally tens of thousands of troops from the United States and South Korea and other countries as well. If you're on geopolitical risk watch, that's something to take note of. Mr. Trump, the President of the United States, will be speaking in Arizona. And then the big highlight, Mario Draghi and Janet Yellen attend the Jackson Hole conference, though I am told the big highlight is actually Monday. My producer forcing this in, the solar eclipse in the United States on Monday. Krishna Memani, the solar eclipse or Jackson Hole for you, sir?
Solar eclipse.
Oh, really? There we go. That puts me in trouble with the producer. Matt Freund, to you, the ECB and what's happening with President Mario Draghi. It was meant to be the main event. And then we had a report earlier this week that suggested we weren't going to get the kind of news that people were looking for regarding tapering. Then we saw the accounts from the ECB's last meeting that actually they're concerned about a euro overshoot. It kind of fades the risk just a little bit from Jackson Hole. Has the event risk diminished for you guys?
Yeah, I think it has a little bit. Again, I think the problem is that everyone wants to talk about having a strong currency, but no one really wants their currency to be that strong. So I think I think the rhetoric will be dialed down a little bit. But again, the ECB is clearly the wild card in world central banks.
Subadra, a lot of people have said that the ECB holds the key to global rates. Does Mario Draghi hold the key to global rates?
In my opinion, yes, because I think what they're going to be very careful to do is to not rattle the markets with another taper tantrum. And bond yields are still at historic lows. So if you see a decent repricing of term premiums in Germany or in Europe, I think that's going to push global yields higher. Worth
pointing out, though, Subadra, that the task in front of the ECB is a whole lot different to the task in front of the Federal Reserve. Yields on bonds are about 50 basis points. Right. Spreads on credit in Europe are ridiculously tight because, unlike the Fed, the ECB's buying corporate debt as well. Is the challenge somewhat bigger for Draghi than it was for Bernanke at the time?
I think so, because of the fact that they have to be very careful to not undo what they've done so far. So they have to be extraordinarily careful about communication. And like I pointed out earlier, it's the environment right now is not really conducive for them to taper because of the fact that the euro continues to be very strong. So I think that they have a very tough balancing act ahead of them.
Krishna, I know a lot of people are critical of the Taylor rule and where rates would be implied by it. But if you just look at, say, the breakdown of Europe and take the Taylor rule and try and work out where rates should be for a company like Germany and compare it to where rates should be for the periphery. Well, you can guess the line at the bottom there. That's where rates should be for the periphery. And you can guess which country is the white line, because that's, according to the Taylor rule, is where rates should be for Germany. Things have changed in the last couple of years. That picture's got somewhat better. But that's still ultimately the problem for the Eurozone, isn't it?
Absolutely. So, well, the Eurozone has structural issues. There's no denying it. I think what the markets have been totally surprised by is the Eurozone's ability to grow at close to 2%. I think 5 years ago, if you had told me Europe was going to grow at 2%, I would have laughed you out of town. Actually, I did. But I think that's the thing that Draghi is dealing with. He doesn't know if this growth rate is sustainable or not. And if it isn't, then taking a chance by tapering too early, I think, is a risk he, unlike the Fed, does not want to take, because the Fed doesn't face the same structural issues.
Krishna, is it a little bit premature for the ECB to be talking about removing accommodation at this point?
Well, I think if you just look at growth, no. If you look at inflation, absolutely. And I think that's the dilemma of the world's central banks. Growth-wise, we have gotten to where we needed to. Unfortunately, from an inflation front, we haven't, and therefore the underlying risks of falling back in disinflation and deflation is still very much there. And central bank policy, to some extent, has to be very cognizant of that.
Guys, you know what time of the show it is? It's where we wrap up the last 25, 30 minutes or so, and we look ahead to next week as well. It's the rapid fire round, so it's one question to each of you with one-word answers if you can. So we begin with a conversation about credit. It's a buy and hold story. You're not allowed to sell. You have to hold to maturity. Similar maturity of Amazon or Tesla, and you've got to buy and hold. Subadra, I know you're a rates person, but you've got to play. So Subadra, buy and hold, Amazon or Tesla?
Amazon.
Krishna?
Amazon.
Matt?
I'll go for Tesla. It's wider here.
If I could give you one speech now, you could take away the speech and do whatever you want with it. Would you take Yellen's speech next week or Draghi's? Subadra?
Draghi.
Krishna?
Draghi.
Matt?
Oh, Draghi.
Here's one for you. Who's at Jackson Hole next year? Chair Yellen or Chair Cohen? Subadra?
Chair Cohen.
Krishna?
Cohen.
Matt?
It's three for three. It's Cohen.
There you go. That was an easy one, wasn't it? Subadra Rajappa from Societe Generale, Krishna Memani from OppenheimerFunds, and Matt Freund from Calamos Investments. Guys, it's been great to have you with us on the programme. Thank you very much. From New York, that does it for us. We'll see you next Friday at 12 New York time, 5 p.m. in London. For our viewers worldwide, you've been watching Bloomberg Real Yield.